If your family home is part of an estate that owes federal estate tax, the IRS can place a tax lien on that property at death, and in some cases, the house may have to be sold before heirs can receive it free and clear. But here's the part that surprises most people. For deaths in 2026, federal estate tax generally applies only when the estate is above $15 million. So the real question is not whether the IRS automatically takes every home when someone dies. It's whether your family could get trapped by rules, deadlines, liens, and paperwork they never saw coming. And that is where a lot of fear online starts. People hear the phrase death tax. They hear that a lien can attach at death, and suddenly it sounds like the government shows up and takes the family house no matter what. That is not what the IRS says. The official rule is much narrower, but if a family does fall into it, the consequences can be serious and expensive. So let's slow this down and make it clear. The federal estate tax is a tax on the transfer of property at death. The IRS says it applies to the gross estate, which can include cash, investments, real estate, life insurance in some cases, business interests, trusts, and other assets. But most estates do not even require a federal estate tax return. The filing requirement kicks in only if the gross estate, plus certain prior taxable gifts, is above the filing threshold for the year of death. In 2025, that threshold was $13.99 million. In 2026, it is $15 million. That means for the overwhelming majority of seniors, retirees, and Social Security beneficiaries, the federal estate tax is not the reason the IRS would come after the family home. And that distinction matters because too many people are panicking over a federal tax that simply does not apply to their estate size. The real danger is confusion. Families mix up estate tax, inheritance tax, capital gains, Medicaid rules, probate delays, and old IRS debts, and they treat them like one giant threat when they are not the same thing. Here is what is officially confirmed right now. If an estate has a Form 706 filing requirement, a federal estate tax lien attaches to the gross estate at death. The IRS describes this as an automatic lien connected to estate tax liability, and it can remain in effect for up to 10 years or until the tax is paid. That is the technical rule behind the scary headlines. But again, it applies to estates with a federal estate tax filing requirement. Not every home, not every death, not every retiree. Now here's why this still matters, even if you are nowhere near $15 million. Once a family starts repeating the phrase, the IRS takes your house when you die, they often make bad planning decisions. Some rush to add children to the deed. Some try to give away the house early. Some assume heirs will owe income tax just for inheriting a home. And some ignore filing deadlines because they believe the estate is too small to worry about any paperwork. Those mistakes can create problems that were avoidable. For example, the IRS says inherited property generally gets a basis equal to its fair market value at the date of death. In plain English, that often means heirs may avoid a large capital gain that would have existed if the property had simply been gifted during life. That is one reason why casually transferring a house to children before death can backfire. And when people receive an inheritance, the IRS generally does not treat the inheritance itself as taxable income to the recipient. So let me ask you this. Have you ever checked whether your family is relying on internet rumors instead of the actual tax rules that would apply to your home? Now let's talk about what changed, because this is where many people got confused. For years, people were told that the higher estate tax exemption was scheduled to fall after 2025 under prior law. The IRS had even explained that absent legislation, the exclusion was due to revert to a lower inflation-adjusted level in 2026. But the IRS later announced that for estates of decedents who died during 2026, the basic exclusion amount is $15 million. So if someone is still repeating the old, the exemption is crashing in 2026 warning as if it is current fact, that information is outdated. Why does that matter for seniors? because many retirees own a home, retirement accounts, life insurance, and maybe a small business or rental property, and they hear these giant estate tax numbers thrown around without context. A family with a paid-off house worth $500,000 or even $1 million is not automatically in federal estate tax territory. But a family with a large total estate, especially when life insurance, business interests, and prior taxable gifts are added in, may be. And there is another major point for married couples. The IRS allows portability, meaning a surviving spouse may be able to use a deceased spouse's unused exclusion amount. But this usually requires filing Form 706. The IRS says that Form 706 is generally due 9 months after death, although an automatic 6-month extension is available if Form 4768 is filed on time. For certain smaller estates that were below the filing threshold, the IRS also provides a simplified late portability method if a complete Form 706 is filed by the 5th anniversary of death with the required notation. That deadline issue is one of the real estate traps, not because the IRS is secretly taking everyone's house, but because surviving spouses sometimes lose valuable tax protection simply by not filing when they should have. In just a moment, I'll explain what would actually need to happen before a home could be sold to satisfy an IRS estate tax issue, and why that process is very different from the rumors you see online. Here's the deeper reality. If there is a federal estate tax filing requirement, the lien attaches to the gross estate at death. If the estate later wants to sell real property, the IRS says the executor may need a discharge of that property from the estate tax lien by submitting Form 4422. That is not the same thing as the IRS randomly seizing the house the day someone dies. It means the property can be tied up by tax law until the liability is resolved or the lien is discharged. If taxes are due and the estate lacks liquid cash, then yes, a sale can become necessary. That is the key phrase. If taxes are due and the estate lacks liquid cash. A house-rich, cash-poor estate can be vulnerable. Maybe the home has appreciated. Maybe there is a business interest that is hard to value. Maybe life insurance pushes the estate higher than expected. And maybe the heirs want to keep the house but cannot cover the tax bill or other debts. In that situation, the pressure to sell does not come from a rumor. It comes from math, deadlines, and legal responsibility. And remember, executors have duties. The IRS says the personal representative must collect assets, pay creditors, file required returns, and pay taxes due before distributing property to heirs. If the estate is insolvent, debts due to the United States generally have priority. So this is not just about wealthy families with mansions. It is also about any family that assumes we'll deal with it later and leaves the executor without a roadmap. Here's another question for you. If something happened tomorrow, would your family know who the executor is, where the deed is, and whether your estate would need to file anything at all? Now, what should viewers realistically expect? First, there is no new universal rule saying the IRS will seize every family home when someone dies. That is false. Second, there is a real federal estate tax framework, and it can affect real property, including a primary residence, but mainly when the estate is large enough to trigger the filing requirement or when other federal tax liabilities exist. Third, families should expect paperwork, valuation questions, and timing issues long before any forced sale scenario appears. What should people do now? Start with the basics. Know the approximate value of your total estate, not just your home. Review how the home is titled. Make sure someone knows where your will, trust, deed, insurance policies, and account statements are. If you are married, ask whether portability planning has been discussed. And if your estate could be large, do not wait until after death for your family to learn what Form 706 is. Those are boring steps, but boring is exactly what prevents expensive surprises. Also, be careful with the advice to just put the house in your child's name now. The IRS says a transfer of title for less than full consideration can be a gift, and gift tax reporting may be required. For 2025 and 2026, the annual gift exclusion is $19,000. That does not automatically mean gift tax is owed, but it does mean casual do-it-yourself planning can create reporting issues and potentially sacrifice the stepped-up basis that inherited property often receives at death. And watch out for misinformation. If someone tells you every heir pays federal inheritance tax, that is misleading. If someone tells you every home is hit by the federal death tax, that is misleading. And if someone tells you the estate exemption definitely collapsed in 2026, that is outdated based on current IRS guidance. Fear gets clicks, but it does not help your family make smart decisions. So the plain English summary is this. The IRS does not automatically seize your family home just because you die. Federal estate tax generally applies only to very large estates, and for 2026, the exclusion amount is $15 million. But if an estate does have a federal estate tax filing requirement, an estate tax lien can attach at death. And if the estate owes tax and does not have enough cash, the home can become part of the solution. That is the real estate trap. Not a universal confiscation rule, but a combination of large estate tax exposure, poor planning, missed deadlines, and confused heirs. If this topic has ever worried you, here is the most important takeaway. Replace panic with paperwork. Replace rumors with numbers. And replace last-minute scrambling with a clear plan your family can actually follow. One final question. Should families be spending more time talking about what happens to the home after death before a crisis forces those decisions? If you want more updates explained this way, with the rumors stripped out and the official rules laid out clearly, subscribe to the channel. We focus on verified information that matters to seniors, retirees, and Social Security recipients, so you can make decisions based on facts, not fear.